Ever wondered how business credit differs from your personal credit? Well, you're about to find out. As we traverse the dynamic world of finance, it's crucial to understand that business credit and personal credit aren't just two sides of the same coin. They are, in essence, two separate coins altogether, each with their own distinct value, purpose, and rules of play. Business credit, for instance, is a reflection of a company's financial health and trustworthiness, while personal credit is a numerical score that represents an individual's creditworthiness. These are both essential financial tools, yet they serve different functions. The rules that govern them differ as well, shaping how they are established, used, and even how they can be potentially mismanaged. So, if you're ready to navigate this financial labyrinth, buckle up. Stay tuned as we delve into the key differences between business and personal credit. Before we jump into the differences, let's understand what business and personal credit actually mean. You can think of credit like a report card, but instead of grades, it's a measure of your financial reliability. Starting with personal credit, this is essentially a reflection of your financial history. It's an assessment of how you, as an individual, have managed your financial obligations. This could include credit card payments, mortgage repayments, or even student loans. The credit bureaus, such as Experian, Equifax, and TransUnion, compile this information and, using their own algorithms, assign a credit score. This score is then used by lenders to determine the likelihood of you repaying borrowed money. Now, moving on to business credit. This is similar to personal credit, but it's specific to a business entity, not an individual. It's a track record of a business's financial responsibility. This includes timely payments to suppliers and vendors, credit card usage, and any loans taken out in the business's name. Again, credit bureaus collect this data, but use different scoring models than those used for personal credit. Lenders, suppliers, and even potential business partners use this score to gauge the fiscal health and creditworthiness of a business. It's important to note that both business and personal credit are influenced by a range of factors. These can include payment history, the amount of debt you're carrying compared to your available credit, the length of your credit history, and the types of credit you have. While these might sound quite similar, the way business and personal credit are used and the impact they have can be quite different. But don't worry, we'll delve deeper into these differences in the next scenes. Now that we have a basic understanding of business and personal credit, let's compare the two. How does one establish business credit as opposed to personal credit? It's not as similar as you might think. Establishing business credit begins with obtaining an employer identification number, or EIN. This number is unique to your business, much like a social security number is to an individual. Once you have your EIN, you can then open a business bank account, which separates your personal and business finances. You can apply for a business credit card and establish trade lines with suppliers to start building your business credit profile. On the flip side, establishing personal credit is a bit more straightforward. It typically starts with applying for a personal credit card or loan. Your payment history, credit utilization, and length of credit history contribute to your personal credit score. As you can see, the process of establishing business and personal credit is quite different. Business credit and personal credit are not only established differently, but they're also used differently. Let's dive into this. Business credit is primarily used for business-related expenses and investments. Think of it as a tool to help businesses manage cash flow, finance growth, and access resources necessary for operation. The use of business credit ranges from covering day-to-day expenses, such as payrolls and supplies, to investing in larger assets like machinery or real estate. Business credit also plays a crucial role in establishing a company's reputation. A strong business credit profile can open doors to better loan terms and interest rates. It can also lead to more favorable terms with suppliers, as they often check a company's credit profile before deciding on payment terms. So, having a good business credit score can mean the difference between net 30 and net 60 payment terms. On the other hand, personal credit is used for personal expenditures. This could be anything from your daily coffee run to buying a house. Personal credit scores impact the terms you might get for personal loans, mortgages, or even your ability to rent an apartment or secure a job in some cases. It's about your individual financial reliability. But remember, while both types of credit are used to secure loans, the separation between business and personal credit is crucial. Mixing the two can lead to personal liability for business debts. This is why it's important to use business credit for business expenses and personal credit for personal expenses. In essence, business credit is a key factor in a company's growth and operations, influencing relationships with lenders and suppliers. Personal credit, on the other hand, is an indicator of your individual financial health and influences personal financial opportunities. So you see, business credit and personal credit are like two different languages in the world of finance. Each serves its unique function and has its own set of rules and implications. Business credit and personal credit play different roles in our financial lives. What happens when business or personal credit is mismanaged? The consequences can be quite severe. Mismanaging business credit can lead to a cascade of negative effects. It can damage relationships with suppliers, lenders, and other business partners who may lose trust in your financial responsibility. It can also limit your business's growth opportunities. With a poor credit history, obtaining additional financing for expansion or innovation can become a significant challenge. On the other hand, mismanaging personal credit can have equally devastating effects. It can lead to difficulty obtaining loans for major life events, like buying a house or a car. It can also result in higher interest rates on credit cards and loans. This means you'll end up paying more over time for the same amount of borrowed money. In essence, the mismanagement of either type of credit can have serious repercussions. It's not just about numbers on a screen, it's about the real-world impact on your business and personal life. To wrap things up, let's summarize the key differences between business and personal credit. Firstly, the establishment of these credits varies. Business credit is established through a business's interaction with vendors, lenders, and creditors. This process often involves obtaining an employer identification number, or EIN, and opening a business credit file. On the other hand, personal credit is established through an individual's financial activities, such as credit card usage, loans, and mortgage payments. Secondly, the usage of business and personal credit also differs. Business credit is typically used for business-related expenses such as inventory procurement, equipment purchase, or expansion projects. It allows businesses to separate personal and business expenses, providing an organized financial structure. Conversely, personal credit is used for personal expenses such as home mortgages, car loans, and personal credit cards. Thirdly, the impact of mismanagement of these credits is another key difference. Mismanagement of business credit can lead to increased interest rates, decreased borrowing capacity, and potential damage to the business's reputation. Meanwhile, mismanagement of personal credit can lead to high interest rates, lower credit limits, and potential difficulty in securing loans or mortgages in the future. Lastly, the way these credits are reported also differs. Business credit reports are public and can be accessed by anyone willing to pay a fee. This allows potential lenders or investors to gauge the financial health of a business. However, personal credit reports are private and can only be accessed with the individual's permission, typically during loan or credit card application processes. Remember, understanding these differences is crucial for managing your financial health, whether you're an individual or a business owner.